Hello, everyone. Charles Canna, Certified Financial Planner here for the Lifetime Income for You channel. Over the last few months, I've been sharing with you some of these economic storms that are in front of us. Any one of them might send us into recession. Take a look at the interview I did with Mr. Michael Gayed the last few days. He talked about what's going on in Japan and China, what's going on in the US bond market, what's going on with NVIDIA. Any of those things could be triggers for our greater problem, which is Chairman Powell has raised rates, probably has one more rate raise in him. And if we go into recession, he has said over and over again, he will not lower rates right away because it's the only way to choke off inflation. And what they're doing so far has not done the trick. The only thing that really went down in price was at the gas pump, and that's because we drained our national reserves. But over the last 3 months, the price of crude oil has gone up 30%, folks, and you're going to see that every day at the gas pump as we go forward. You've already seen inflation, what it does to you at the checkout line of your grocery store. And let's not even talk about restaurants because they've gone up about double what the price of groceries have. Inflation is on top of us day in and day out. Most economists have said that with a soft landing inflation or without a soft landing recession or without a recession, 3% to 3.5% is the lowest inflation that Chairman Powell could expect, but he is sticking to his guns. He wants 2%. And in Fed speak, that means that he is actually expecting recession, and he is not going to lower rates on recession because he's also said Chairman Volcker in the late Jimmy Carter years lowered rates too soon, and that's when we got that double-headed recession where he lowered rates to get us out of recession, and then we had to go back into it because he had to re-raise rates. So he is not going to do that this time around. Let's take a look at all the other things that maybe you're excited about. If you've guided your own portfolio the last 10 years, guess what? You did really well because you had to. There was no place to go where you would have done poorly. It's not because you're great at this, right? Let's take a look. Are you in bond funds? Bond funds don't own a duration, and because of that, they are really getting hammered. A lot of Vanguard bond funds, for example, lost 10 to 15% last year, and then look at them year to date, they might be up 2 or 3. You're not getting the bounce back. The TLT is the iShares 20-year Treasury. It is the biggest bond fund in the world, $40 billion. Lost 31% last year, folks. And guess what? It's down 7% or 3.5% this year. And that's with a 3.5% yield. So that means the value of the fund has gone down 7. And that's what happens when you are a part of a bond fund, because you are at the mercy of the other people inside that fund with you, and you don't own a duration. So come on to cannonfg.com, schedule a call with me, take a look at some of the interesting income strategies we employ that shield you from that Wall Street version of diversification that doesn't work. It didn't work in 2008, 2018, or 2020, and it didn't work last year in 2022. Bond funds don't work, folks. They don't cushion your portfolio at all. So let's take a look at some other income strategies, because income can protect your growth portfolio. Speaking of growth, let's take a look at some of these stocks that everybody thinks are so great. Apple. I shared with you early in the year, Tim Cook sold off some Apple shares. The last time he did that was 2018 when Apple was down 30%. Just in the last few days, it's gone from 195 to 175, so 10, 12% in just a few days. NVIDIA was trading in the 275 range all spring. And then that fear of missing out around AI, man, it spurred a growth. It topped out at 492. And just as it got to 492, we found out that their CEO sold off $40 million worth of shares. And so it's gone down to 458 over the last couple of days. So let me ask you, those CEOs are selling off shares to put the take some of the cream and put it on their side of the line. Why aren't you doing the same? Now is a perfect time to do that, because if your portfolio lost 20% because it was in the S&P last year and you've gotten 15% of that back or so, heed the warnings. Every time it gets within 5 or 7% of the highs, it starts to recede again. Heed the warnings. Read the storms that are out there. Michael Burry taking a large short position against the NASDAQ 100 and the S&P. Warren Buffett now hoarding $150 billion of cash. When's the last time he did that? Yeah, before 2008, right? Because he wants to swoop in and buy at lower prices. So yes, turn some of your gains from this year back to cash and then swoop back in if that's what you want to do, if you want to be fully invested. But better yet, get on our schedule, canonfg.com, push schedule a call, get on our schedule, and let's make sure you've got the income you need so that you can stay invested and feel confident. This is Charles Cannon, Certified Financial Planner. I want to remind you, lifetime income is the most important part of your retirement. And please, please, please don't ever forget that. Bye now.